All right, welcome. Today is August 18th. It is Monday, a new week, new opportunities. And I'm so grateful that I'm here to be able to host these calls for you guys. And just like always, every Mondays we start off with a week overview. So I'm looking at Investopedia, according to Investopedia here, what to expect in the markets this week. Federal Chair Jerome Powell is actually speaking this week. He's going to deliver some remarks at the Jackson Hole Symposium that's happening this weekend. So it's a 3-day event. The Jackson Hole Symposium. It is the Kansas City Federal Reserve Economic Symposium. This economic policy symposium held in Jackson Hole, Wyoming, is attended by central bankers, finance ministers, academics, financial market participants from around the world. The meetings are closed to the press, but officials usually talk with reporters throughout the day. Comments and speeches from central bankers and other influential officials can create significant market volatility. Now, we have a booked week this week, along with the symposium and unemployment claims and earnings report from several companies and manager index, the euro. They have the PMI numbers coming out this week, which is a purchasing managers index. I'm sorry, purchasing manager index. And you guys can go on to Forex Factory and read through this information. And I use Forex Factory as a guide to get my resources, my news, all the data, all the information that it's all of this is fundamental analysis. So I like to gather all my data from here, all my numbers, so that way I can make an educated decision before I enter a trade or invest into a stock or to a crypto or to any type of asset. You want to make sure that you do your research and your analysis when it comes down to the fundamentals. And it's important to keep in mind of all these events. There's mild events, there's high impact events. So all the orange folders are mild impact, red folders are high impact. Now, on Wednesday, we have nothing going on today nor tomorrow. However, Wednesday we have the FOMC meeting minutes, basically an overview of what happened on the last previous of FOMC meeting. It gives you a quick summary. And we have Thursday, we have obviously the unemployment claims that happens every Thursday, which is the number of individuals that filed for unemployment insurance for the past week. And last week's number was at 224,000 people that filed for unemployment claims. Now they're forecasting 226. And so an increase in the number, which will impact on the dollar. So the dollar, the more people filing for unemployment claims, it's going to push the dollar down. It's going to weaken the dollar. And it's going to push the assets to the upside. And especially for gold and the dollar, they have a inverse relationship. And sometimes they go in the same direction, whether to the upside or the downside. And you could look at it in the markets when you do your technicals, you're able to see that movement, that volatility. Now, before you dive into that, you always want to make sure that what the number is going to be, uh, what's going to occur, what is the result. So whenever you do trade news or decide to trade news, make sure to trade after or before the news event. So you can see the time here when they release the numbers. So every Thursday they release the unemployment claims at 5:30 a.m. and this is Arizona time, which is 7:30 a.m. Central Time, uh, and that is 8:30 a.m. Eastern. So every time there's a news event, they release the numbers right exactly at this time. So you want to keep in mind of the time which these results will happen, and depending on the numbers, whether it is a high number or a low number, it's going to directly impact the technicals and your trading analysis. So you want to keep that in mind and do not trade during news. Do not trade right away when at 5:30, for example, right? At 5:30, okay, I'm going to enter at 5:30. No, because there is a speculation. It's all manipulation. So you just don't know where the direction of the market's going to go. It can liquidate, There's always a liquidity sweep happening. There is central banks, the hedge funds will come in to wipe out all the retail traders and take away their profits and they hit their stop losses, right? So no wonder, yeah, I used to trade during news and I'll try to time the market and beat the news, but I come up short and I get liquidated. Why? Because the 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 hedge funds, the bankers, they know that most people are gonna either buy or sell, and whenever there's a consolidation, and typically when there's news events happening prior to the news event, prior to 5:30, for example, there's always a slow movement. There's a consolidation happening. There's a slow movement, and there's not that much volume going on because there is a news event happening that day, right? So before 5:30, you may see a consolidation, you may see a slow movement in the market, not too much activity going on, and there's a liquidity buildup. And when the numbers release, there's a liquidation happening, there's a liquidity sweep happening, whether to the upside or the downside. And we can dive into that more on Wednesdays when we do chart work Wednesdays. So today, like I said, is just market overview, looking at the news, looking at what's happening this week. And so according to Forex Factory, we have a pre-booked week starting on Wednesday through Friday. Saturday, we have back-to-back events. This week, a lot of traders and investors and business owners and economists will be actually looking at the Jackson Hole Symposium because this is going to show what's going to happen this September when they start to cut rates. They're predicting an 83.2% chance of cutting rates this September, the Fed rate. Now, the target rate is 2%. 2%, that's their goal. It's above 2% right now. Last time I checked was at 2.67, 2.7 percent. Now, with President Trump, with all these officials, they're pressuring federal Jerome Powell to to cut down the rates, it's time to cut rates. It's been over a year since they last cut the rate. It's been at the same at 4.33% between 4.25, 4.5, but the effective rate is at 4.33% approximately. And it's been at that same number for a year now. And they haven't cut since December of last year, right? So now if the Fed cuts, right, if there's a decrease in the rates right now, given in today's numbers, right, borrowing becomes cheaper. And there's a reason why the Fed are not cutting rates right now because they're worried about inflation. They're worried about if we do cut rates, that's going to increase inflation. It's going to increase the price. It's going to devalue the dollar and it's going to weaken the dollar and it's going to increase price. And it is going to it's going to make borrowing a lot cheaper, right? Mortgage rates, car loans, credit card, people refinancing the debt, borrowing will become cheaper the more they cut rates. Now, for businesses, for consumers, they have that borrowing advantage, right? They can borrow at a cheaper rate. For businesses, however, lower cost of capital, more willingness to expand, hire, or invest in other projects. And there's so many companies are laying off individuals, laying off people because of the high interest rate right now, the high Fed rate. And I know one of my good friends, he actually got laid off from his job just recently, and it's unfortunate, and it's real stuff that's happening out there, and a lot of people are getting impacted by these rates and the job layoff, and so every week they release unemployment claims, and they list the amount of individuals filing for unemployment, filing for insurance. So and it's crazy, not crazy because it's just the nature of the market, right? It's just the nature of the economy of where we're at right now. I actually was a witness of someone getting laid off because their company, they just can't afford the amount of employees because of payroll. They can't afford the amount of the amount of employees and they can't afford the payroll. So that's why they're laying off people. And one of my good friends, it impacted him. So it's tough times right now because of where the numbers are at right now because of the Fed rate not willing to cut rates right now. But they do start cutting down rates, and it's going to benefit the businesses. It's going to lower the cost of capital, more willingness to expand, lower the cheap rates, lower the amount of borrowing. It's going to become cheaper, and it's gonna benefit the businesses. It's going to lower the amount of capital they have to spend, and they're going to save up a lot more. And therefore, they're going to start hiring more people because now they have capital coming in and they're able to afford the payroll. Now, when it comes down to the asset prices, when they do decide to cut rates, stocks, real estate, crypto often get a short-term boost because cheaper borrowing and better liquidity make the riskier assets more attractive. So crypto is going to boom, real estate is going to boom. The index says that the commodities, all these assets will boost up because borrowing would become cheaper. Bond prices go up as yields fall. Now, with the bond prices, when it comes down to real estate, for example, is it's directly correlated with the 10-year bond yield, right? So with real estate, you want to look at the 10-year bond to see if it's below, if it's at a stable rate. Now, when they push down the Fed rate, it's going to benefit that market. And bond prices go up as yields fall. Now, for demand increases, of course, right? The cheaper the rate, demand will increase spending on goods, services, and investments. However, the risk on that is that this boost in demand can put upward pressure on prices. So the bigger the demand, the higher the prices. And it's going to pressure the consumer price index, the consumer spending. It's going to stress that number, especially in sectors already facing supply constraints like housing, energy industries. Now, demand, yes, will increase when the Fed cut the rate. Now, that is short-term effects between 0 to 6 months. 0 to 6 months, you'll see bond becoming cheaper. You'll see asset prices rising. You'll see demand increasing. Now, we want to look long term, right? And that's what the Feds are considering. It may be good in the short term, but long term, the medium effects between 6 to 18 months, inflation pressure can return. Yes, we may want a lower rate, but that's going to impact inflation. Now, obviously, because as demand increases, prices will tend to increase. If inflation is still above the Fed's 2% target, like today's number with CPI is at 2.7%. 2.7%. And I can show you guys this graph here. This is the price, I'm sorry, the personal consumption expenditure, right? It's a byproduct type, can be classified in these different categories. And the Fed, they look at the core PCE. The core PCE right now is at 2.79%. 2.79%. So it's above the 2% target goal. And that's what they're looking at. They want to respect the dual mandate, which is following proper procedures to bring down inflation and to have stable prices, a stable economy, and a strong labor market. That's the dual mandate for the Federal Reserve. Now, looking at these numbers, if inflation is still above the Fed's 2% target, like today's 2.7 consumer price index and the the core CPI. Now a rate cut risk re it may reaccelerate the prices. Lower rates will lead to more demand, and more demand will lead to potential price increases in housing, rent, travel, and discretionary spending. And that actually weakens the dollar. So when we see these numbers coming out, it will weaken the dollar, and we can go to the dollar index here. It will weaken the dollar, and as we can see here on this graph, the dollar index is between this range, this price range. If it's above 105, it's a strong dollar. It's a strong dollar. It's a slightly a stable market, but the dollar becomes stronger and they're printing more dollars, thinking that that's going to solve inflation, but it does not solve inflation. And we can look throughout the years, the more money they print, the more money they print, it just loses value over time. And we can look at the weekly here, how the dollar has been losing value over the years for decades and decades since the creation of the Federal Reserve back in 1913, when they come up with the tax code and income tax, the federal income tax and the personal income tax and the personal income. That was when they created the tax code, and they started to print money. And now when the dollar got taken off the gold standard, the dollar's not backed by gold anymore. Money just became debt, and I can show you guys here, which resulted the national debt, which is over $37 trillion dollars and continues to increase. And it by going to this debt clock, you guys can do your research as well and look at these numbers, and it's just not it's not getting better, right? They're printing more money, they're spending, they're taking debt, they're funding, reinvesting, and they're taking home less than what they're spending. So we see the numbers here. It just doesn't make any sense why they put so much value into printing more money and the central banks lending money to the average consumer at a certain rate. And we know with today's rate, right now, it's just not a good idea to take out a loan or personal loan or even applying for a credit card. It is not a good idea to take on much debt because you'd be paying interest, you'd be paying fees back to the bankers, back to the government, and they're recapturing all that for their own good, and you're not gaining none of that interest back. You're giving up purchasing power to them. You're giving up, you're using the dollar as a way to finance your life, which is if you finance your life by taking on more debt, then that is not ideal. That is not a good idea. So the goal is to minimize the debt and maximize your returns, to maximize your profits, to yield those rewards, right? And to keep it as well. And to keep, they say you finance everything that you want in life. You finance everything in life, whether it's a car, whether it's a house, you finance everything in life. And you pay cash for it. Okay. You pay cash for it, you're giving up purchasing power because you're losing that dollar, you're losing that value. You're not gaining nothing in return. You're not gaining any interest of every dollar that you're investing or spending. You're not gaining none of that back. You're not seeing that dollar ever again. You're giving it up to the banks, to the finance companies. So rather than financing it that way by taking out debt, having your own system where you can actually put that dollar into good use and have that dollar to compound uninterruptedly compounding interest where you can recapture that interest, gain that interest instead of giving up the interest. So there's so many ways for you guys there's loopholes when it comes down to this. So the more you study this, the more you realize that, wow, what I'm doing now is not going to benefit me long term because it's just a cycle. You're saving and you're spending. You're saving, you're spending, and you're taking out debt, and then you have to use that source of income, however, whatever amount, whether whether it's a one source, two source, three sources of income, you're using that sources of income to pay off the debt, to finance, your car or whatever, or to spend, for your lifestyle. But how much of that, out of every dollar, are you gaining that back in interest? So that's a question for you guys to think about. How much of every dollar you're spending are you getting that back in interest? How much of it is it going to you, not the other way around? Now that's what I teach everyone here, and is that when you look at the numbers here, and when you do your own research, and you look at the news, and you look at what's happening in the economy, you're able to see that this whole system is obsolete. It is it's a corrupted system that they're running here, thinking that all this is going to solve everyone's problem. But why are there still people getting laid off? Why are there still people in so much debt? Why is the whole country is in debt? So it, it it just puts everything into perspective. Why would we trust them? Why would we trust the traditional banks, these traditional products, these traditional ways of putting our money to work? Why would we trust these people to handle our money if they can't even handle their finances? And we can see it here. They can't even handle the debt, the amount of debt that we all have as a collective. So, anyways, we'll talk more about this in later calls. And going back to this chart here, we saw that the dollar weakens. A weaker US dollar makes imports more expensive, which can also add to inflation. However, it can help exporters by making US goods cheaper abroad. And there's a whole conversation about tariffs and Trump pushing tariffs and making deals with all these countries. Now, that is a good strategy. Well, according to the US officials and Trump, why they're pushing tariffs, they're being very strategic. And it's a good strategy, right? It's because they're using that as leverage to gather the profits from what they're making from the tariffs. They're gathering those profits, those taxes to reinvest into these assets, especially crypto, AI, and all the tech companies. NASDAQ 100 hitting all-time highs. Why do you think S&P 500, NASDAQ 100, they're hitting all-time highs right now? They're reinvesting all the profits from, and they're leveraging tariffs to do so. and they're investing billions and billions of dollars into crypto, into AI, and AI data centers, quantum computing, because they know that is the future. That is the technology, especially with technology nowadays. It's evolving, it's growing. Companies now like NVIDIA, creating the chips, Meta, BlackRock, Google, Microsoft, all these tech companies and investment companies, they're reinvesting their profits into crypto, into AI for to expand their businesses, to expand their clientele, to gain control of what's happening right now. So it can benefit them, right? But we also got to beat them in their own game. By knowing this information, you have an advantage of what to do and what not to do, where to put your money to work, where not to put your money, and looking at the history, tracking the financial statements and the history of these companies, and seeing which company is it's worth to invest, which asset is worth to invest, which crypto is worth to invest. You want to be able to know this information before you even dive into the financial markets, before you even take a risk. You want to know the pros and cons. You want to know the players behind the game. If you don't know, then you're diving into this field, into the markets blindly, not having a game plan. Now, here on this channel, the more you watch these videos, the more you learn, the more you see that all this stuff it's all manipulation. It's a chess game. Plus, chess is chess, not checkers. So you want to play chess against the big dogs, and you want to beat them in their own game by knowing this information, because it also impacts your personal economy. And it all starts with you, the individual watching this video, watching this recording, wherever you are, whatever background, you have the opportunity, the ability, and you have the opportunity to gain back control. You have the opportunity to expand uh, to expand your personal economy, to prosper your personal economy. It all starts with you. And when you take the initiative, and I hope you do, you will impact the people around you. You will impact your loved ones, your family. So it all starts with the individual to have control of their personal economy, to have that independence in order to make an impact long term. And it's going to be a domino effect. When you take the initiative, it's going to impact the next individual and the next individual. It's going to be a compound domino effect. And it'll make the economy, and this is my opinion, and this is my opinion, that it all starts with you to create a better future for yourself, your personal economy, and that's gonna compound. And as a whole, living here in the US will boost up the economy and will make the economy better by each individual doing their part and playing their role of their financial economy and getting that control. And you don't want to give up that control to somebody else. You don't want to give up that control to the hands of somebody else, because obviously look where we're at right now. It's not making things better. So when you learn this information, yes, you got to have a team of people, but be selective with who you work with. Be selective who you do business with. Be selective who is going to invest your money, or uh, who is going to help you create this game plan. And look at the reputation of that individual or company that you're doing business with to see if they're trustworthy. It all comes back to trust. Now it's a mindset. It's bigger than just making money. It's bigger than just looking at numbers and looking at returns. It's bigger than that. You want to create a legacy for yourself. To be a becoming a wealth creator takes a different mindset. And it's important to learn this information because it impacts your personal economy and the people around you, and as a whole, the entire economy. Now look at the credit growth expands as well. Going back to this information, I know I went I kind of, went off a little bit off topic there, but it's something that I needed to share because it puts everything into perspective the more you learn this information. And so now we going back here, the credit growth expands. Lending standards often loosen as banks compete for borrowers. This can lead to more consumer debt, good for short-term growth, but risky if incomes don't keep up. So the amount of credit cards, the credit lines, and this can lead to more consumer debt. When the dollar weakens, inflation pressure can, sorry about that, with my calendar. Uh, when inflation pressure can return, isn't an effect with credit cards. Credit growth expands because rates would become cheaper. When they decide to cut rates, rates will become cheaper. Lending standards often loosen as banks compete for borrowers. So banks will be competing for loans, giving out credit cards. This can lead to more consumer debt because more people will be applying for more credit cards because they know they'll be getting a cheaper rate. Now, it may be good for short-term growth, but long-term, it's risky if incomes don't keep up. And we're looking at every week, we're seeing unemployment claims. We're seeing at the numbers of the number of people filing for unemployment every week. So it become risky when people get laid off and they don't have enough money to pay for their credit cards. So it can be risky long term. Now, in 2+ years, if they cut too early, let's say September, they're predicting an average of what, 86%. They're predicting a rate cut. Prices can start climbing again if they cut too early before inflation is fully under control. Their target rate is at 2%. We're well above our 2% target rate, our 2% goal. We're well above that. Now they prices can start climbing back again. Prices can start climbing again, forcing the Fed to reverse, uh, forcing the Fed to reverse course and hike later, which is disruptive for markets. This is what happened in the 1970s. When I look back in the 1970s, with oil, there was a stagflation. Stagflation, it's high unemployment, high inflation. That is stagflation. We have a recession where everything just drops. A recession is it's another cycle of the market, but we also have a stagflation where we have high unemployment, high inflation, and this is what happened in 1970s when oil just dropped. It impacted the monetary policy, which worsened inflation cycles. If they cut rate at the right time, where inflation is stable, the economy is slowing, that's the proper time to cut rates, don't you think? Is when inflation is stable and an economy is slowing, and they're waiting for that to happen. They're waiting for a stable, slow economy where inflation is stable near our 2% goal to start cutting rates, which can support a soft landing, quote unquote, keeping unemployment low while maintaining price stability. Those are the long-term risks. In 2+ years, if they cut too early before inflation is fully under control, we may see prices continue to go up. We may see a reverse of action. We see a reverse, a hike later, which that's that happened back in the 1970s when the prices of oil went down and stagflation started to happen and high unemployment and high inflation. They don't want to go through that. They're preventing that from happening. They don't want to continue, they don't want to repeat that cycle. But how the numbers are going, with high inflation and unemployment, right? With the unemployment continuing happening, i- is there a stagflation? Is a stagflation happening right now? Is there a stagflation happening soon? So that's the question that we got to keep in mind is that what's happening right now? Is there a stagflation happening right now? Did it already happen earlier this year when everything just dropped? S&P 500, NASDAQ, the stock market, crypto, it impacted all markets across the field. Everything went down because of tariffs, because of wars. It impacted the markets. And we can see here, going back to the charts, we can look at the S&P 500 now is hitting all-time highs. Earlier this year, look at this. In the red section, we saw a push down. After President Trump took office, we saw a push down. Now, this is similar to what happened back in the 1970s. And we can go back here. It's good to backtest this as well. Stagflation, 1973, 1975. We saw a push down in the S&P. 2 years. 2 years where price came down. It started in January 73. It hit an all-time high. And after that, it just tanked. For a whole year, for 2 years, 1974, it hit the bottom and price pushed up. And by the end of 1975, prices surged. Now here in today's numbers, it was a few months, right? So this is we've been in a recession, right? This is a recession here, a recession where a stagflation recession, the only difference is the inflation, unemployment, the Fed rate. When you get all those three, when you see high inflation, high unemployment, and high Fed rates, then obviously a recession can occur. But when you see high inflation, high unemployment, it's more of a stagflation. Now, we can talk more about this later in later videos, the difference between recession and stagflation. But I just wanted to show you guys here how this could tie into what's going to happen 2 years from now if the Fed decided to cut rates today, coming September, if they decide to cut rates right now, it may it may push prices. It may it will they'll be at they'll have uh, the banks are able to borrow. Borrowing will become cheaper. Spending, people will start spending because that they'll get better deals. If they decide to cut rates by 25 basis points in every Fed meeting. So they're looking for a soft landing where they keep unemployment low while maintaining price stability. Now, in today's context and today's numbers, there's pros and cons for cutting rates. The pros, labor market is cooling, CPI is stable, and growth is slowing. The economy, yes, it is slowing down little by little. The labor market is cooling down, although we do still continue to see unemployment. Uh, and week by week, we see less amount of unemployment people. I'm sorry, yeah, seeing less amount of people filing for unemployment little by little. The labor market is cooling. CPI is stable. It's above our 2%, but it's coming near little by little. It could prevent a recession and support business investment. Those are the pros of cutting now. If they decided cuts in September, that's the benefit of what could happen. Potentially, it could prevent a recession from happening and support business investment. Now let's look at the cons if they do decide to cut now. PPI, the producer price index, which is a wholesale inflation, is surging, which leads to possible future consumer price increases. Consumer prices can increase, which will increase inflation. It could undermine the Fed's progress in anchoring inflation expectations. Now we're near 3% inflation, between 2.7 3%, considering all the numbers with PPI, CPI, core PCE. It's in between that range. It could undermine the Fed's progress in anchoring inflation expectations if we do decide to cut now, which is a risk of increasing prices, increasing borrowing, increasing debt. So bottom line, if the Fed cuts rates right now, the economy will likely get a short-term boost, but there's a real risk of reigniting inflation, especially in housing, services, and energy. Given that core CPI, the core consumer price index is still above 3%, and wholesale prices are running hot. So guys, keep a lookout in today's numbers and what's happening later this week with unemployment claims, existing home sales, earnings. We have the PMI, the producer price index. I'm sorry, the producer purchasing managers index, which is a leading indicator of economic health. It's a survey that they do, and that will create a consumer sentiment to see where do they predict inflation to go or the Fed, the rates to go. What are their view of the economy? What are their views on the rates? They'll be conducting surveys over that, which will influence on the decision whether or not to cut rates. And they're now predicting, as we can see here, 83.2% chance that they're going to cut rates by 25 basis points coming September. So we'll keep a lookout on that every week as we do these market overviews every Mondays. And this weekend will be a interesting event happening with Federal Jerome Powell at the Jackson Hole Symposium, alongside with other leaders and economists and policymakers. They'll be watching that event and they'll be saying their remarks and giving their perspectives and opinions and where the economy is going to go and what's going to happen prior to September, after September, when there's on the next Fed rate. Now, I appreciate you guys for listening in. This is Market Overview every Monday. Make sure to like and subscribe. And I hope you guys have a blessed day. And I'll see you guys on the next one. God bless.